Now let's consider preparing a tax schedule for the project. So basically year-wise tax payments, right? Looking at scenarios of corporate tax as well as what MAT, typically what we call as minimum alternate tax. We'll talk about wherein we figure in minimum alternate tax as well as the corporate tax. So we'll look at year-wise kind of a schedule for that, and at the same time we would also focus on using the written down value method of depreciation rather than the straight line depreciation method for computing the tax. So keeping all these things in mind, it's better that we understand the whole process of preparing a tax schedule, because this is one more input that has to go into our P&L statement for the computation of our final profit after tax. So we will try to create using the existing P&L statement and making the modifications regarding the written down value method and the straight line depreciation method, arriving at the new particular value based on which we will be doing the computation of the tax. So what I'll try to take up is, we'll create one more sheet. We'll create one more sheet for tax computation. And because this is also an yearly kind of a schedule, I will keep the first two lines more or less the same. If this is equal to blank, leave it as blank, otherwise populate it with this particular value. So again, the first couple of years or couple of lines will remain the same, and I drag them until the column AZ to maintain consistency for each of the years. So this is what we are preparing, and of course now I would update the tax related stuff. So the typical tax related stuff which we would talk of is, we will start with PBT. See, as I said, we have to take the written down value method of depreciation rather than the straight line depreciation, which means what I was thinking of is, probably to this PBT add back this straight line depreciation and subtract the written down value method depreciation to arrive at the updated PBT. So based on that updated PBT, I can try out for the computation of tax. That updated PBT which is coming by taking the written down value method of depreciation into consideration is what is the taxable income for the company. So from that standpoint, we can very well consider, probably when it comes to the tax, I will simply say to the PBT add the straight line depreciation and subtract written down value method depreciation, and that is what I typically call as my taxable income. So based on which we will think of computing the tax rate. Alright, so what I can simply look at again is, if this is equal to O, then I am bringing in the PBT from this particular period. Otherwise, I am leaving this as blank. So this part is clear for me. The PBT is something which I am pulling out from my existing P&L statement, and all these are linked, so no problem at all. So this is my PBT, and wherever possible, probably until here, I'll put that formatting scenario, the number based formatting. So this is my PBT, and probably even this number based formatting I would go for highlighting the red. That would be much better. Okay, this is my PBT. I'm adding the straight line depreciation back. So if this is equal to blank, right, if this is equal to blank, I'm leaving it, or probably if this is equal to O, then only I'm adding back the straight line depreciation. So either from the P&L itself I can add back the straight line depreciation, otherwise I'm leaving it as the blank. So even for this period I'm able to highlight the depreciations which I'm going to add back. Right, this is the depreciation that is getting added back, and less the written down value method depreciation. So I'll simply consider, if this is the operations part, pull out the, from the depreciation, pull out the written down value method depreciation, otherwise leave it with a blank. So the written down value method is coming out to be something like this. So from here, what is coming out for me is the actual taxable income. So when I'm saying taxable income, again, if this is equal to O, I'm going ahead with the summation of these two and the negative of this. That is what is going as a part of my taxable income. So I'm computing here, this is blank, and going ahead it is working out like the taxable income in some years is negative. So the actual tax is applicable on these particular values. So whatever is the tax rate that we are talking of, it is applicable on these values. Right? The corporate tax rate is applicable on these values. So, and one more thing we have to be comfortable with is, here we have three scenarios to look at. In case of taxing, we talk about three scenarios. One, if the taxable income is less than 0, logically speaking, no tax is applicable. But there is one more thing, even though my taxable income is less than 0, if the PBT for that year is greater than 0, right? If the taxable income is less than 0, we have to check out if the PBT is greater than 0. We talk about applying a minimum alternate tax on the PBT. We have a minimum alternate tax to be paid on the PBT, but which would be typically adjusted, because at the end, only when the taxable income is greater than 0, I am liable to pay a tax. Right? We are looking at 3-4 scenarios. When the taxable income is greater than 0, I am liable to pay a tax which is taxed at the corporate tax rate. And wherever my taxable income is less than 0, I will get the tax losses are carried forward. What does that mean? Any kind of loss that I am going to get, these are the losses. On these losses, I am paying a tax. I'm not supposed to pay a tax, right? These are the typical losses. So what the mechanism says is, until all these losses are covered, until my profit exceeds all these losses, I need not pay any kind of tax. But a MAT would be applied, which would be credited at later points in time. So probably the way I would like to look at is, I will create a few instances here talking about net or cumulative taxable income. I'll create one scenario called cumulative taxable income just as an appendix, wherein I will talk about the summation of the taxable income from here till here. I'll do the summation of the taxable income up to this particular period. That is what I call as the cumulative taxable income, where probably I will do, or I can do it right from this year itself, cumulative taxable income. But even that also, with if this is equal to O, I'll do the summation of the cumulative taxable income by freezing the B here. I'll do the cumulative taxable income, and otherwise I will leave it as blank. Now logically, why did I do this? When I'm dragging it, one important pointer for me is, during which year is the tax really applicable? Only where the cumulative taxable income is coming out to be positive, that is where I'm supposed to pay the tax, right? Only where the cumulative taxable income is positive, that is the year where actually the tax incidence comes into picture. But in the meanwhile, we have the scenario of the MAT coming into picture, especially where my taxable income is negative, but still the PBT is positive. In that year, we would still pay a PBT. We are still supposed to pay a PBT, which can be recovered at later stages. But whereas when it comes to the actual incidence of tax, the actual payment of tax, or the actual applicability of tax, it starts from the period where your cumulative taxable income is positive, because the tax losses are actually carried forward. So because you had a few years of tax losses, logically speaking, you are supposed to pay 34% of minus 10. So probably minus 3.4 crores has to be paid as a tax, which means the government is due by the extent of 3.4 crores to you. So that's like an asset for you. Whatever the tax that you are supposed to pay, that is an asset, because you are not supposed to pay, and at the same time you can recover that much of amount even in the years when you are becoming actually profitable. So only from this year onwards you are supposed to pay the tax, right? So before that, right, we'll try to use that cumulative taxable income into our logic slightly later. But the next thing is, if we have any kind of a MAT, Right, we'll try to see the first computation of MAT. How do I look at the MAT? If at all my taxable income is negative but the PBT is positive, it is in that period the MAT is applicable for me. So though I am paying it, I can get the credit for it at a later point in time. Though I am paying the MAT now, I will get the MAT credit. Means when I am actually going for a payment of the tax, I will still get the credit for the same. So that is where we are talking about the MAT credit. So what do I look at in the computation of MAT? I will see, even if the cumulative, right, probably one thing what I can simply look at is, if this is the operation space, I will check if the cumulative taxable income is less than 0. If the cumulative taxable income is less than 0, or probably I can take if the two rules, and I will take cumulative taxable income less than 0, comma PBT greater than 0. When these two rules are met, I will pay the MAT on my PBT. So I will pay on the PBT, I will pay the MAT percentage, minimum alternative tax. The minimum alternate tax on the PBT amount is typically paid. So I'll go for this number. The minimum alternate tax on the PBT is paid if that both the rules are typically met. Otherwise, no MAT is paid, and even if it is not an operating phase, the MAT is not applicable. So what we are saying, when I am dragging it across till the AZ column, I will get out that wherever my cumulative is positive, there is no MAT that is getting applied. Wherever the cumulative is negative as well as PBT is negative, even in those cases there is no MAT that is applicable. But when my cumulative is positive, when my cumulative is negative as well as my PBT is positive, that is where the MAT is getting applicable to me, right? So cumulative is negative but the PBT is positive, that is where the MAT is getting applicable. So those are the MAT numbers that are coming up. And when it is coming to the taxable income, or probably the corporate tax, so though we are paying this much, right, though we are paying this much, this is a minimum alternative. So we are paying this much of tax in each of the years based on the PBT, but logically speaking, this much credit we will get, this much of credit we can still get in case we are becoming profitable in any particular year. because logically speaking, until this year I'm not supposed to pay any tax, right? Until this year I'm not supposed to pay any tax, but I have paid this much of tax in the form of MAT. Though for my P&L statement this may not be applicable, but whatever I have paid in the form of MAT, whatever I am paying in the form of MAT, that would be credited also, means I can reduce my tax to the extent of MAT that I have already paid. So even in the years when I am actually getting profitable, right, on this amount, though I have to pay a tax, which is the corporate tax, I can still remove the MAT credits out of that. I can still remove the MAT credit out of that, and I can pay the remaining balance as the tax, right? So in this case, though this much of tax is applicable for MAT, what I can very well do is I will also put up with cumulative MAT, means this is the tax I have paid because a PBT was generated positive, not because of I have really generated profits, because my tax is actually done on the taxable income, but because my PBT was positive, there is a minimum alternate tax that was charged, which can be adjusted from the period where my taxable income is actually the total cumulative taxable income is becoming positive, and I end up paying the actual taxes. So from that standpoint, I am also computing the cumulative MAT, which will work out as, if this is equal to O, I am doing the summation of the MATs. I am doing the summation of MATs from here to here, with the first one being frozen. I am doing the summation of the MATs, otherwise I am leaving it as blank. Okay, so this much of MAT has been paid till date. So this much of MAT has been paid till date, right? So overall around 6.4 crores has gone in towards the MAT. So what we are now looking at is, when I compute the corporate tax, so I'll compute the corporate tax now, which is based on the cumulative. So wherever the cumulative is becoming positive, that is where the tax is incidence for me. So from this year onwards, on my taxable income, probably this is the year when I am turning positive. So this is where probably the tax is applicable. This is the year from where the tax is applicable, which is the 34% of the taxable income. But of course, if at all it has not crossed the total cumulative MAT, if it has not crossed the cumulative MAT, I don't need to pay even a corporate tax in that particular year also. So computing the corporate tax wise, all I can do is, if this is the operations phase, I can look at if the taxable income is greater than 0, whenever my taxable income is greater than 0, total cumulative taxable income is greater than 0, all I can talk about is this particular taxable income times whatever is my corporate tax rate. What is my corporate tax rate here? Almost 34%. So I'll take that, and if it is not greater than 0, right, if the taxable cumulative taxable income, if it is not greater than 0, I am not applying the corporate tax rate at all. Only the MAT would be applicable for me. So I am going ahead with that logic only. So the corporate tax rate, whatever is coming out, I am considering up to the AZ column. So the corporate tax rate, yes, this is what is going to be the corporate tax based on the taxable income that is getting generated in each of the years. So from this year, let's say this is the corporate tax that is getting applicable for me. Now at the same time, I will get the MAT credit, right? At the same time, I will get the MAT credits because I have already paid some amount of MAT earlier. So my tax should get reduced in the later years by the extent of the MAT credit. Because though I have created the MAT as my expense, but because I am turning profitable, I need to claim the MAT credit, which is more and more of the adjustment for the tax that I have paid in the earlier years, though my taxable income was negative. So from that standpoint, how do I look at it? If this is the operations period, right, if this is the operations period, I would consider the summation of all the MAT that I have paid till date. So that much has to go as a part of the MAT credit. So logically speaking, in the first year where I am making my corporate tax, right, where I am making my corporate tax, I need to look at adjustment for this MAT credit also. So what I would be considering, I would be considering the maximum of whatever the MAT credit that has happened till date. So cumulative MAT credit, okay, I will go with the minimum of let me just think through this. Okay, so I would typically consider if this is the operation space, what I would look at is if the corporate tax part is blank, I'll retain it as blank only because I'm not bothered about the MAT credit there. But if the corporate tax is not blank, I would look out for the minimum of either the corporate tax for that period or whatever the MAT, cumulative MAT minus whatever the corporate tax that has, or whatever is the MAT credit that has happened earlier. So I'll take the minimum of either the corporate tax for that period or the cumulative MAT minus whatever has been credited till date. I will take the minimum of whatever the corporate tax. If I take the minimum of the corporate tax or whatever has been credited till date. So from the MAT credit, cumulative MAT, if I am talking about whatever has been credited till date, what would I get? If I am taking out the minimum, if this is blank, I'll leave it as blank. If it is greater than 0, I'll take out the minimum of those two. So the total cumulative MAT minus whatever has been credited till that particular period, if I am considering those two. Let's see how it works out. And if it is not blank, I'll leave it as blank. Let's see how it works out. The MAT credit initial years, yes. Yeah, all these numbers are coming out to be zeros. Very good. I think we are on track. So how did we write this formula typically? The MAT credit is applicable for these 2 years because whatever has been the total MAT credit is 6.41 and this has been we have paid a total of 6.41 crores in the form of MAT, whereas in this year the corporate tax that is that I am liable to pay is around 4.53 crores. So I still don't need to pay because I have already paid this much and I can get a credit for that much. So that's where what we are taking is we are taking the MAT credit out for that particular amount. So the actual tax incidence for us is the net of all these things. So what is coming out is the total net tax, total tax to be paid. So when I am computing this schedule, the total tax to be paid, I am simply taking, if this is the operation space, consider the summations of the MAT, the corporate tax, and take out, the MAT, the corporate tax, and take out the negative of the MAT credit. All this is what goes as the total tax to be paid, and after that I am taking it out. So overall it is working out that the total tax to be paid is, or the total tax liability for me is coming out to these kind of instances. All right. So the summation is actually giving us error. So what you can easily work out is write one simple formula saying if error of this entire calculation, you leave it as blank. Straightforward way to address this. If error of this entire calculation, leave it as blank and probably you can drag it across. So all it is working out is these are the various taxes that you have to pay, but of course here Here, the drawback that we are getting into is the summations of these things. Actually, the tax has to be applicable in this particular year also. So, the way I would look at is, instead of putting if error, probably let's not put if error because that is resulting in a wrong calculation. So let's try to adjust the formula itself better. Right, we'll adjust the formula itself. What we'll try to do is, we will take here, we'll take the summations of the MAT, the corporate tax, and the negative of MAT credit. If I'm taking all these three things separately, how is it working out? Still giving me a value error. So in these cases, if this is equal to O, I am doing the computation, I am doing the summation of all these things, and these are all actually blanks. So rather than blank, okay, the better way then would be, instead of keeping a blank here, if D9 equal to blank, what if I say 0? What if I say I substitute with a 0? Yeah, things are working well. So probably in this case, instead of putting D9, because for the negative, I think it's not working out. So what you could very well do is, instead of putting it as a blank, I can very well put it with a 0. Then this will work out very well for me. So at least the calculations for the initial few years, the MAT is coming up, and whatever the MAT credit that is coming up here, we are adjusting for that MAT credit. So this is what is going as the total taxes to be paid in each of the years. So what I can do is, I'll come back to my P&L statement. Under this tax scenario, I'll again put up, if this is equal to the operations phase, I will directly pull out the tax, total tax to be paid from here, otherwise I'll replace it with a blank. So obviously with this again another cyclical loop will start, right? Because this is the tax incidence in each of these periods. Another cyclical loop will start, updating my P&Ls, profit after tax, in each of the periods. In some cases, this is the taxes that are applicable as the project is getting older and older. These are the taxes that are applicable in each of the periods, and even it is reducing the profit after tax, because this is what will go as a part of our cash flow statement now. So creating a tax statement, what are the tax expenses incurred based on the MAT as well as the corporate tax all put together, how would we take it as a part of our P&L statement, is one of the critical things we have to work out, because tax is a very significant number as far as our expenses are concerned. So handling that is one of the key aspects when it comes to the profitability verification, or even deciding the value of the particular project. Alright. If you have any queries regarding the same, on how to prepare a tax schedule, or what kind of considerations or what kind of calculations go into it, you can please get back to me on the number that I have given below, or you can drop in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.